Welcome back, everyone, to another episode of Ready, Aim, Retire, the show where we talk about real markets, real money, and strategies to drive your confident retirement outcomes. It's been pretty good, Tony. I think last week we had Chris on, one of the new wealth advisors, and at the end we said we got a really big get. And the emails have been flowing in, the phone calls have been. Everybody wants to know what the heck's going on. But before we get to him, the star of today's show, I haven't had a chance to talk to you, Tony. What's up? What's new? What's happening there in Minnesota?
Well, after last week's show, pretty much I spent the entire week fielding calls and questions about who's this big guest you're going to have on the show that Rob mentioned. A lot of names were thrown out there. Warren Buffett, they said, is Warren Buffett going to be on? Is it Mr. Wonderful from the Shark Tank? I know that, you're friends with a lot of people there, Rob.
Yeah.
And I said, no, bigger.
Yeah, this one supersedes.
And they said bigger, and I said no. I said Binger. Mike Binger from Gradient Investments.
Wait a minute, you guys are talking about me? I was waiting for some superstar to walk through the door.
You are the superstar, Mr. Binger. And we have the aforementioned that Tony was throwing around there. They try to get on this show. We don't have the slots available. Michael Binger, president of Gradient Investments, he doesn't have the slots available. For me to get him in here, the last time I'm not even sure if he's been here this year. It's been very difficult to get him in. He may have been in early in the year.
I believe I was here earlier this year.
You might have been here earlier this year, but it's been a while. It's been too long.
Yes. It's due time is what it is.
It is. We're overdue. And for those of you that are listening and you don't know who Michael Binger is, he's a CFA, president of Gradient Investments. He's been guiding advisors and investors for decades through market cycles. We're super excited to have him. I'll pound him with a whole bunch of questions, so those of you that don't know him can get a better feel for Mike. But we're happy to have him. I've personally known Mike for probably now, I don't know, 13, 14 years.
Yeah.
I've had the pleasure of being a guest, a repeat guest. I've been there a few times to Mike's beautiful lake house on Lake Minnetonka. For you Minnesota people listening,
nice.
He's done well for himself, this gentleman. I can assure you that. So it's always enjoyable going up there. But Mike,
yes,
for our listeners that may not know you, can you give me a little bit about your background, like your career path and how you ended up to lead Gradient Investments as the president?
I can. So I was born and bred in Minnesota. I grew up in a first ring suburb of Minneapolis called Brooklyn Center. I ended up going to the University of Minnesota. I got my finance degree there, and then I joined a company called Lutheran Brotherhood. That's where I started my investment career. I became an investment analyst there. Lutheran Brotherhood did some mergers, and they became Thrivent. God knows what consultancy firm they paid to come up with that, but they did. And so I spent 22 years at Thrivent. I was an investment analyst. Then I finished out there as a portfolio manager, managing multi-billion-dollar portfolios. And then I came to this little company called Gradient Investments, and we were about 180 million. I came over as a portfolio manager here. And we got this thing going here, and a few years later, 13 to be specific. All of a sudden now we've gone from 180 million to 8.5 billion with a B. So it's been a great run. I love doing it. My true passion is in investment management and portfolio management and stock selection. But being the president of Gradient Investments, it's hard to find time to do that. You find yourself managing people more than investments. But we have a great investment team here. We have portfolio managers. They all have their CFAs. So I have a lot of confidence in them. In fact, I handpicked all of them. So really confident in that. And we just keep moving up and to the right here.
Perfect. Now, Gradient's built a strong reputation on portfolio construction. That's why we came there, originally tactical management. What do you think separates Gradient from other traditional, wirehouse strategies? When people are out there looking, they're like, who are Gradient versus these guys? What's the difference, do you feel?
Yeah, I'm going to give you three things. The first thing is I believe, one of my mandates to the whole Great Investments company is we want to have good portfolio product, good investment models that are competent, that aren't swinging for the fences, but are keeping people in the game through thick and thin. And I want to have a full suite from, very conservative portfolio models to more aggressive, such as our digital discovery portfolio, those kind of things. For our advisors, I want to have a mixture of portfolios that any client who's sitting in front of them can mix and match those to have a custom financial plan with these portfolios for the long term for them. Secondly, I believe it's our service. Great Investments I'm very interested in excellent service, and that not only extends to our advisors, but also to the advisors' clients. And then thirdly, I think it's access. I mean, our portfolio management team is accessible. Rob, that advisors can call and advisors can get their clients and have a conversation with these folks. In addition, we'll go out to the advisor offices and, we'll give state of the states and join their client appreciation events. So at the end of the day, I think that Great Investments, the advisor and the client, it's my goal to make that a very collaborative investment path over 10, 20, 30 years. And I feel like we've achieved that. Yeah. And it's a two-way street of collaboration.
I totally agree. And like literally our clients through the years, I can speak to this, that they feel they know Mike. I was talking, Mike, the other day to Frank Arcabello. You know that guy?
Yeah, I know.
He's down in Florida.
Yes.
He's living the life down there, and he was asking about you. And I said, you know what? I'm actually going to see him on my podcast. And he's like, tell him I say hi. And I go, make sure you listen to it and subscribe, like to be on there. But we've had a great relationship. It's always interesting to me where we could see, Mike or one of the portfolio managers be on CNBC one day and literally be in your office speaking to clients the next day. They could be at a Christmas party or a client event. And I think that kind of access, and I've spoken to several firms. I have friends in this industry, obviously, that doesn't exist, and I think that kind of human touch, when you have somebody that's really managing your money on a day-to-day basis, come in, talk to you, very accessible. I think that's probably one of the number one reasons we work with Great Investments. In fact, it is the number one reason that we work there. So that's fantastic.
Yeah, that's huge, actually. I mean, these big box investment firms that you see are most financial professionals and advisors out there can't pick up the phone and on the cell get the president of the investment firm where you have your clients' money invested and managing. You can't get the senior portfolio manager to show up and talk to your clients in person.
Sure.
Most people cannot do that. You can, Rob, but most people can't.
That's true. And I'm not saying it's easy to get President Binger on the phone. I'm not saying like I don't want to go like too far to one side of it. It's not easy.
This guy has my cell phone number.
Yeah, he does. Yeah, I've seen the texts. Yes. Believe me. Yeah, they're
okay. Let's move on to something serious.
Yes.
Let's talk about the government for a second. So we are in day 37 of a government shutdown.
Yes.
We haven't seen, markets really, it's almost like they've shrugged it off. Now this week, might be a little bit more pressure on it. What are your thoughts, first of all, on the government shutdown? If it goes, another week, 2 weeks, what's that going to do to markets? Or, just give us your general thoughts on it.
Yeah. Okay. So the markets have kind of shrugged off this government shutdown because I think it's the 27th government shutdown we've had.
Mm-hmm.
And on average, they last, less than a week. In fact, the longest government shutdown we've ever had is 34. So we're in record territory here a little bit right now. Yep. And the markets also shrug off government shutdowns because if you look back in history, the average gain in the market following the conclusion of a government shutdown is about 12%. So markets do well after a government shutdown. Okay. So that's why the markets are shutting them down. But now we're in record territory. It's extending beyond what people are getting comfortable with. We just heard like the FAA is going to, shut down about 10% of the flights that are out there. So it's starting to have some economic logistics effects.
Right.
So I think, and we're not seeing a lot of movement on either side to come together on this. So I think that it's now going to start cutting into economic growth a little bit, and it's going to start raising the ire of people. So I think the markets could react a little bit negatively if this thing goes on another 2 weeks. And you put that in connection with that the markets are already at, pretty elevated levels over the past 2.5 years. And you do have a little bit of a stew for, a potential, quick pullback, maybe, 5%, something like that.
Right. Until, maybe they get the conclusion. But if this thing ran into Thanksgiving, for instance,
yeah,
you'd have to think that the gains that we've enjoyed this year would probably come off the table, because that would cause it'd be an absolute disaster.
I don't think all the gains would come off,
Right.
but
And a lot of the gains.
but I
Like,
think the
there'd be
portion
a bigger pullback, I
yes,
guess.
yes. I mean, you really balance. You're balancing a government shutdown and what that might do or might not do to the economy. I mean, it certainly hurts pockets of people, who aren't getting paychecks or whatever, or benefits. But on an overall economic basis, it's really, even if it extends to Thanksgiving, it's not going to affect the growth numbers all that much.
Right.
And then you put that on top of an AI, artificial intelligence trend, their tailwind that's lifting the market here. Doesn't seem to be stopping anytime soon. I think if we saw a 5% pullback, it's more of a sentiment pullback than a fundamental pullback, and I would use that as an opportunity.
As an opportunity to buy. Well, let's roll right into that. So going into this year end, we'll talk about 2026 in a moment, but we don't know how the government shutdown ends, but we know one thing, we know for sure it ends. Just like everything else, any things in the market or things in our society, eventually they end. So this thing eventually ends. What are your thoughts, Mike, going into year end? Like it's been one of those, we've had some volatility this year. Obviously we had the tariff situation back in April with a massive drawdown, but it's pretty much been straight up from there. Maybe a little pause in October, but it's been pretty favorable. So how do you see, we don't know when the shutdown ends, but we know it's going to, how do we see the end of the year going?
All right. I'm gonna just lay something out here right now for you. Okay.
I'm ready.
The market likes certainty and it dislikes uncertainty. And that really drives things up and down in the short term. So when you look at those two scales of certainty versus uncertainty, I mean, it's pretty certain right now that the economy is doing well. It's pretty certain that corporate America is doing extremely well. We got the big, beautiful tax bill, and it's pretty certain now that taxes aren't going to go up.
Yep.
Tariffs were an uncertainty earlier in the year, but now it's kind of the new certainty. We're going to tariff collectively the rest of the world on their imports, their exports to us. What we import, we're going to tariff them at about 15%. That's pretty certain. So we look at a lot of things and things are pretty certain. Now, the new uncertainty out there is the government shutdown. But outside of that, things are pretty certain and are moving along. And the market likes that. And that's what I think the market reflects. So I think that wherever you are right now, I wouldn't pour fresh money in the market right now, but I certainly wouldn't be a seller. I would just ride whatever you have out through the end of the year, because I think we can still move a little higher, kind of sideways to a little higher as the year progresses.
Well, okay. All right. And I would imagine you would think that when the shutdown ends, and it will, you probably get a little lift off from that, because usually you come mid-November, mid-December, that's a sweet spot in the market. You get that Santa Claus rally. People go to Thanksgiving, they talk about accounts, they're putting money in, and things kind of roll nicely. So we just hope for get that shutdown and get moving on here a little bit. What about the Magnificent Seven, Mike?
Well, when you talk Magnificent Seven, you're talking these artificial intelligence stocks, And we know the names there, Broadcom and Nvidia and Microsoft and Google and Meta / Facebook, all these companies. And they're leading the market and driving the market right now. And they've all just reported their earnings for the third quarter, and they all look good. And they're all going to spend more on artificial intelligence. And I've said that I think we're in the early innings of this AI spend and wave and implementation and all those kind of things. I still think I'm just going to do a baseball analogy. I think we're in the third or fourth inning here. So we have more to go. Right now we're spending out, we're building data centers, we're manufacturing AI chips, all these things. And once that's all built out, we'll use all this information that AI has on how to implement it and make our, corporate America more efficient and productive, and how to make our lives more efficient and productive. I'm a little old and stodgy, but I'm starting to use AI right now.
Sure.
I'm not afraid. Some people are afraid of it. I'm not afraid of it. I think it's going to make our lives, more productive, more efficient, easier. It's going to be a tool that we all use. And I liken it back to the, to the 2000 late 1990s when the internet era was coming upon us, and people going, oh my goodness, what's this internet going to be? But imagine your life without the internet right now, without email and those kind of things. I mean,
we actually wouldn't be doing this show right now without
it.
Nope.
Exactly.
We couldn't do it.
So I'm a believer in AI. I adopt it for what I can use it in my life and at great investments and those things. And I think this wave is going to continue on. The big difference now with these AI companies is they have great earnings. They have a ton of cash flow. And that's a big difference from the tech bubble. For those of you who
I was going to ask you
that back in the 2000s,
the .com crash,
where they're just valuations made no sense.
Right.
But today there's cash flow, there's earnings, and there's sales in these companies that are leading the AI wave, and they're called the Magnificent Seven. I would not sell those.
Okay. Yeah. I mean, pets.com, people were buying up pets.com stock like crazy, and they hadn't made any profits.
Anything.com back then, right? Like,
it was just, if you had a .com,
they weren't measuring company success with earnings and sales. They were measuring it by eyeball views on web pages and things like that. It was ridiculous.
But you feel that's not the bubble we're in currently? Do you feel we're in an AI bubble at all currently, Mike?
I mean, we're a little extended, but the growth is there. So the valuations of the AI companies and their stocks are extended, and they're extended because investors truly believe, as I do, that the growth will grow into the extended valuation.
Yeah.
Right.
And every quarter they prove that they are growing at rapid rates and those kind of things.
So they are growing, and there is profit and actual things happening.
Yes.
But you might have some overvaluation. I mean, look at Nvidia. My goodness. Trillions.
The valuation isn't that high though. The price to earnings is in the 30s.
But they have the earnings
but they have
to
the
justify
earnings.
it.
Yeah,
right?
that's true.
I would
They
much
make a lot
rather
of money.
take a high PE multiple company that their earnings are growing rapidly than a low PE company where their earnings are stagnant or declining.
Oh, sure. That makes sense.
The markets love growth, and AI is where the growth is.
Yeah.
Yep.
Yeah, totally agree. All right, let's change gears. So, going into year end, we talked about that a little bit. What do you think, Mike? So we're going into 2026. So, we're, basically everyone's been pricing that in for the last 3 months or whatnot. But we go into 2026. First of all, what are your thoughts on the market in 2026? Like, what are we going to be looking at? And what do you think the big tailwinds are? What's going to help us get to wherever we got to get to in 2026?
Okay, let's talk about a couple tailwinds first.
Okay.
The first tailwind, I think, is going to be AI and technology and continued ramping up there. That's going to lead the market again, I think, in 2026. A second tailwind is, I think, interest rates are probably going to be cut more in 2026 than be raised. So I think the trajectory of interest rates is lower. The market likes the Fed when it cuts interest rates, and that's a good background for the market. So I think those are a couple tailwinds. The third one, tailwind, I think, corporate America, I mean, their earnings growth is just astounding. I mean, people came into 2025 kind of questioning how can these corporations continue to grow like they are?
Right.
And we've had double-digit earnings growth in the first, second, and third quarter. They've beaten expectations, and I expect that to continue too. So with that, what I worry about a little bit is, the federal debt, tariffs, things like
Huge.
that. I mean, interest rates going up are bad because, we do have a lot of federal debt. It's 37 trillion now. By the end of the year, it could be 38, and sometime in 26, it could peak over 40.
Right.
But it's not like it ever comes due, or someone comes up to us and say, "Hey, where's my 39 trillion?" I mean, they
Shutting down
roll
America.
over, yeah, and they roll it over, and when a government bond matures, they just issue another one. But when they issue them now, the interest rates are a little higher, most likely, than the ones that matured. So the government debt service charge, the interest payments that the government has to make on their debt, it's getting bigger, and it's getting bigger at a higher interest rate.
For sure.
So we have to pay it, and the government has to come up with that revenue somewhere. So tariffs are going to help because all that money goes into the government from tariffs.
Yep.
But I do worry that if government debt gets to be a problem down the road, that taxes might be raised because that's another source of revenue. It's the easiest source of revenue for the government to get. And that would take money out of consumers and corporate pockets and start that earnings flywheel and spending flywheel going the other way. So that's what I worry about. So to make a long story longer, I'm still positive going into 2026. I see more tailwinds and, a constructive backdrop than I see negative fundamentals starting to show up.
Okay. And I would agree with everything Mike said. Like, I think when you see declining interest rates, which I think most economists feel it's going to go in that direction. Again, anything can happen, folks. We don't know. We don't have a crystal ball, but the trend is kind of going in that direction, and that definitely helps stocks, but it also helps consumers. Consumers are going to be able to refi these mortgage rates that they got at 7, and maybe they get it at 5.5 or something like that. Saves them money, allows them to take that excess money, put it back into the economy, which keeps everything, kind of moving along. So consumers definitely need it. Car companies definitely need it to sell cars. So we need those interest rates down. We just don't want that trade-off, Mike, of the high inflation. We don't want that sneaking in. I think that's the needle they're trying to thread here.
It's always a balancing act between growth, inflation, and rates. I mean, that's always on every investor's mind. But I just think the Federal Reserve has done a very masterful job of walking that tightrope over
I
the
agree.
years.
I totally agree.
I mean, when they need to grease the skids of the economy, they lower rates. When inflation gets to be a problem, they act quickly and bring inflation down. So inflation right now is about 3%, and trust me, the market does not like inflation because the way you control it is the Fed has to raise interest rates. So it's a 3%. They'd like it more at 2%, but to me, 3%, 2%, it's kind of the same.
Right. And let me ask you this: because I know this is kind of what they're looking at is they look at the inflation, and it seems lately the last the last 2 months anyway, a new number's been on their mind, which is the unemployment rate.
The jobs
That's creeped up. So what are your thoughts on that, Mike? Like it's currently say 4.2, 4.3, somewhere in that range. Where does an unemployment rate have to get to before gradients like, what, we're going to have an issue? Is that a 5, 5.5, 6? Like, where does that look like?
So long-term averages are around 5%. So we're still below long-term averages. It's still, it's harder to find people to work, but the tech sector really overemployed, overspent. They're still doing it, but they're starting to get more efficient and laying off people a little bit here now. So I do expect unemployment, which is now 4.3%, to gradually rise. So I think at 5, people are going to get concerned. I think at 5.5, the economy may start to slow down a little bit. So it's really the 5 level that we watch here at Gradient Investments, and we need to start making some decisions on how defensive we get or those kind of things at about 5%. Yep.
Reallocating portfolios or changing strategies. Speaking of the portfolios, Mike, it wouldn't be a show with Mike on here if I didn't give him the soapbox of the Gradient Investment suite of offerings. But let me ask you this: going into 2026, you guys have, I want to say, is it 35, 40 different strategies that you're able to use there, right?
Yep.
What are you leaning towards? Like are you guys still you have that core portfolio that has a blend of value and growth? Are you still feeling like, you know what, I kind of like the setup of this market? The dropping interest rates probably going to help the equity side of things. How are you feeling about that, and kind of where are you guys leaning?
Yeah. Good question. Okay, crystal ball time. But
yeah, get the crystal ball out.
I still, if you want a long-term portfolio that does well in the economy and over market cycles, and remember, markets are up 3 out of 4 years historically, and I think that's going to be the pattern going forward. I still love the Core Select. It has a great portfolio manager, Keith Gangle. It's its benchmark is the S&P 500. It's done well versus that. It has elements of value, growth, and core stocks or large caps. So you're really getting, in my opinion, 60 to 80 of the best companies stocks in the country.
Right.
So I like the Core Select. But with that, I would also start looking at, and we're really looking at this, international stocks are starting to pick up. We have a portfolio called the G40I, and the I stands for international. And it's 40 international high quality companies, Toyota, Nestle, things like this. They're just domiciled internationally. And it's got a nice yield. It's close to a 3% yield. And I like it. There's such a valuation gap between U.S. stocks and international stocks, and that's starting to close. And usually when that happens, it happens for longer than a 1-year period. So I would not be afraid. Look, if I had, say, $500,000, I would put $250,000 in the Core Select. I would put $125,000 in the G40I, and I would put $125,000 into one of our buffered index or dual directional buffered index portfolios. That way you can, and those strategies, and Rob, Tony, those are, investors are just demanding those monthly offerings that we bring out every month. And it allows investors to participate in the market upside while still having some downside protection in their back pocket. Right. And I believe that with, elevated valuations, where the market is now, with some of the things that people are worried about, climbing unemployment rates and maybe inflation higher than where we want it to be, having a little protection is not a bad thing.
Right. And those structured notes that you guys have in the buffered index, there's every month there's probably a half a dozen at least, maybe more, that I see come across my desk. And we have a lot of clients that utilize the buffer with the 100% upside to the S&P or the Dow, and they have a 15% protection. So if the market went down in the period of the note, which is usually 24 months, I believe, if it went down 20%, you only lose 5. If it went down 10%, you lose nothing. That's kind of nice to have in your back pocket.
It is.
Like, you know what? But I get all the gain. So if I get the market's going well, I'm going to get the gain. I'm going to enjoy that. But I have this just in case. And we do a lot of the ones that are 100% principally protected. Yeah. Where they come down with interest rates, but again, principally protected. If I have, a CD or I have something like that I'm looking for that 100% principal protection, and this gives me, a possible upside of 10, 12% over 18 months, I probably like that, where I can't lose anything. So yeah, those have been popular, and I believe, going forward, again, we've been up for a few years, been pretty nice, going into the next year, things are setting up nice, but like anything else, no one knows when the market goes down. No one knows because if they did, all the money would go into cash and we'd wait, and then you go. Nobody has a clue, but all we know is, like Mike said, 3 out of the 4 years are up. That means 1 out of the 4 years is down, and it's just We just don't know what's going to cause that. But Mike, I have to say to you, obviously incredibly insightful as usual. I wish I had more time with you. I know you're a busy guy, and I know, I'm a busy guy, and Tony, and you're a busy guy, so we're all busy guys.
Yep.
But if you need more information, folks, you can always visit GradyInvestments.com. If you want to find more about Grady Investments, you can come right to our site. Give us a call at 630-780-1099. Go to our website at apadvisorsgroup.com. Lots of information on there, and about this. But give us a call, because these things, as we position for 2026, we want to make sure that you're positioned for 2026, because there's nothing worse than riding a high and having most of my stuff in NVIDIA, Mike, and then it goes in the wrong direction, and I've built up this big gain, and life is good, but I think the party is going to last forever, and we all know it doesn't. So it's good to have some protection built in there, or some diversification to say, you know what, I made pretty nice on this. I better save that and diversify it out.
I would agree, Rob, 100%.
All right. Well, Mike, thank you very much for coming. Thanks for carving the time out with you. We appreciate it, and I appreciate you. So thank you very much, and thanks for taking some time with us today.
Yeah, I appreciate what you do out there. Thanks for having me. Let's not make it another year.
Right.
All right.
All right.
Mine.
Yeah. And if people have questions or want to talk to Rob, call 630-780-1099. That's 630-780-1099. And thanks for tuning in to Ready, Aim, Retire with our host, Rob Kirvan, and special guest, Mike Binger.